Welcome back to the deep dive. Today, we're digging into something pretty fascinating in the Indian logistics world. It's a huge sector, right? Like $250 billion. And we're looking at VRL Logistics, a big name, and their latest results for FY26 up to September 2025.
Yeah, and the numbers, well, they present a real head-scratcher. At first glance, anyway.
Exactly. Because normally in logistics, it's all about volume, isn't it? More tons moved, more money made. Simple.
That's the usual playbook. If tonnage drops, alarm bells usually start ringing.
But VRL, they seem to have flipped that script completely. It's almost, well, counterintuitive.
It really is. We're looking at their November 2025 investor presentation and the board meeting notes, and you see this stark contrast. Profits are way up. I mean, way up. Over 100% year-on-year for the first half.
100% profit growth.
Yeah, staggering. But at the same time, the amount of stuff they actually moved the tonnage, it fell by about 12%.
Okay, so that's the paradox. Profits double, volume shrinks.
That's our mission today, really, to unpack how they pulled this off using these documents. It wasn't about moving more, it was about moving smarter, I guess. It's definitely not Logistics 101. This is more advanced strategy.
All right, let's get into those numbers for you, the listener. The financials first. That H1 profit figure, just wow. Net profit after tax pat up 103% year over year for the half. That's 100 crore.
And it wasn't just a fluke in one quarter. Q2 itself saw PAT climb 39% year on year, 50 crore there.
So consistent, strong profit growth. And the margins.
Oh, the margins tell a huge story. EBITDA margin for the half year hit 20.3%.
20.3, that's massive for transport. What was it before?
It was 15.4% in the same period last year. So a huge jump at 20.3%. It really puts them in a different league, honestly. Way above typical road transport margins globally.
Okay, but here's the first piece of the puzzle, right? All that profit growth, but their total income.
Almost completely flat.
Yeah.
Just a tiny 0.2% bump in Q2 and only 1% for the half year.
So same amount of total money coming in, roughly, but profit doubled. That points straight towards efficiency, doesn't it? Or pricing.
Both. But let's immediately contrast that with the volume numbers, because that's crucial. The documents are clear. Tonnage handled down 11% in Q2, 12% for the half year.
12% less freight. Normally, you'd think that's bad news.
You would. But the company actually explains it. They say it was partly due to contract restructuring. And this is key, a voluntary strategic exit from low-margin business. They chose to drop some work.
Voluntarily giving up 12% of your volume. That's a bold move. I mean, doesn't just hand business over to competitors. Even low-margin stuff helps cover overheads, right? And keeps your trucks moving, keeps market share. Aren't they risking losing ground long-term?
That's the gamble, absolutely. It's a high-stakes bet. But look at the P&L. It clearly worked, at least in the short term. Their calculation was basically the cost of servicing those cheap contracts, fuel, driver hours, vehicle wear, just wasn't worth the tiny revenue. So they traded scale for profit. They're banking on their service quality being good enough to attract and keep higher-paying customers, make that lost volume replaceable,
Okay, fair point. But that only works if you can actually charge more for the freight you do keep, which leads us to realization, right? The price factor.
Exactly. That's the other huge lever they pulled. Realization per ton.
And what happened there? Did it go up enough to compensate for the lost volume?
Oh, yeah. And then some. In Q2, realization per ton jumped 12% year over year. That's 8,079 per ton. And for the full half year, even better, up 14% year over year, almost 8,000 per ton on average.
14% higher price per ton. Okay, now the math starts to make sense. Less stuff, but much higher price for each bit of stuff.
Precisely. And this wasn't just some random luck. It connects directly back to their strategy. Remember the price hike they brought in back in Q2 of FY25? That's part of it. And the other part is cutting out that low-margin business in Q4 FY25. By getting rid of the cheap freight, the average price naturally goes up. They're effectively filtering their customers, aiming for premium, and it seems customers are willing to pay for it.
Right, so higher prices are key. But pushing margins from 15% to over 20%, that can't just be pricing. Cost control has to be massive, too.
Absolutely, ruthless cost control. And they give some great details on this. Fuel management is a big one.
Fuel is always huge in logistics. What did they do?
They basically cut out the middleman more often. They started buying more fuel in bulk directly from refineries. That went up to 40.6% of their fuel in Q2 FY26, from about 35.5% the year before.
Wow, shifting over 5% of your fuel sourcing in a year. That's a big operational change. Takes investment, I'd imagine.
It does, but look at the payoff. The average cost per liter they paid in H1 dropped from 86.04 down to 84.30.
So saving almost, what, 1.75 per liter across thousands of trucks.
Exactly. That adds up incredibly fast. It's a real competitive advantage built just on how they buy diesel. Plus, they pushed hard to use their own trucks more instead of relying on external, usually more expensive, hired vehicles. And things like optimizing driver schedules, making sure drivers and trucks aren't sitting idle, getting the most out of every asset.
Makes sense. But I did notice one cost line item went up quite a bit, administrative expenses, from 1.4% to 2.3% of income. Is that is that a sign they're getting a bit bloated, or maybe not watching the overheads as closely while focusing on the big stuff?
It's a fair question to ask. When you see a line item almost double, you do raise an eyebrow. But the note suggests it's more about necessary housekeeping than bloat. The main drivers were higher legal and professional fees that could easily be tied to exiting those old contracts, maybe setting up the new premium positioning. And there was also a loss booked on selling or scrapping older vehicles, which, is part of keeping the fleet efficient.
So maybe a one-off cost to get leaner.
Seems likely. And the overall picture, especially the cash flow, supports that it was probably a worthwhile trade-off.
Ah, the cash flow. Let's talk about that. Did it improve with the profits?
Yeah, massively. All that efficiency really shows up here. Net cash from operating activities, it soared. Went from 217 crore in H1 last year to 334 crore in H1 this year.
Huge jump. That kind of operating cash really gives them flexibility.
It underpins their whole model, really, which brings us to how they operate.
Right, their core identity. They call themselves the only asset-owned LTL player in India. LTL is less than truckload, right?
Correct. And that LTL business is like 90% of their sales.
Hmm.
Being asset-owned is the key differentiator. They own the trucks, the hubs, the whole infrastructure.
And the scale of that ownership is pretty immense, isn't it?
It really is. Over 5,700 of their own goods transport vehicles, all running through this hub-and-spoke network, 1,243 branches, including 50 major hubs spread across almost the entire country.
Owning that many assets must come with costs, though. Debt, maintenance.
You'd think so.
Yeah.
But here's where it gets really impressive. Their fleet financial are incredibly healthy. Get this, 80% of their vehicles are completely debt-free.
80%. Owned outright. No financing costs.
Exactly. Imagine the cost advantage compared to competitors who are constantly leasing or paying off loans, and it gets better. Another 16% of the fleet is fully depreciated on the books, meaning no depreciation charge hits the P&L, but they're still running efficiently.
So they're basically running a huge chunk of their fleet almost for free from a capital cost perspective, just fuel and maintenance.
Pretty much. It's a massive cushion for their margins. It's why they can be selective about freight. And this owned model helps tackle another huge industry problem, the driver shortage.
Ah, yes. Finding skilled truck drivers is a major issue everywhere.
India is estimated to be short something like 2.2 million skilled drivers. It's a huge bottleneck. But VRL, they treat drivers like a core asset too. They directly employ over 8,600 drivers on payroll.
That must help with reliability and retention, surely, compared to relying on contractors.
Absolutely. If you're promising a premium, reliable service, which they need to justify those higher prices, you need reliable, well-trained drivers. Having them on staff is a structural plus.
So owned assets, employed drivers, it all feeds into reliability and cost control.
And that translates into some really impressive operational metrics, like their collection efficiency. Trade receivables, the money customers owe them, averages just 12 days.
12 days? That's incredibly fast. They get paid almost immediately.
Yeah, it means cash comes back into the business super quickly. That fuels the operating cash flow we mentioned. It's very disciplined.
What about risk? Are they reliant on a few big customers?
Nope, very diversified. Over 9 lakh GST-registered customers. No single customer makes up more than 1% of their revenue. Low concentration risk. Plus, they boast the lowest claim ratio for damaged goods in the industry, just 0.08%, and almost zero bad debt, 0.02% provision.
That low claim ratio speaks volumes about operational quality. Fewer mistakes, less damage.
It reinforces that whole premium service argument.
Sure.
And underpinning a lot of this is their tech. They use their own in-house developed ERP system for everything, not off-the-shelf software. And I thought this was neat. They use OTP-based unlocking for vehicles for verified deliveries, like a one-time password to open the truck.
Adds security, reduces theft or errors, I guess.
Exactly. Helps keep those claim ratios down.
Okay, so that's VRL's internal picture. What about the wider market they're operating in? Any tailwinds helping them?
Definitely. The overall Indian logistics market is huge and growing, like you said, and the road freight part specifically is expected to grow at around 9% CAGR,
Yeah.
hitting something like $236 billion by FY30. So the market's expanding. Plus, government initiatives are helping. Things like the National Logistics Policy, PM Gati Shakti, dedicated freight corridors, they're all aimed at making logistics smoother and more efficient.
And who benefits most from that?
Large, organized, asset-heavy players like VRL are generally well-positioned to take advantage of those infrastructure improvements and policy changes.
Right. So they've nailed profitability in their current setup. What's next? Where does the growth come from now?
The blueprint seems clear. Stick to the core goods transport business, but expand geographically.
Where are they looking?
The documents specifically mention targeting the north and northeastern regions of India.
Okay, those are big areas, potentially lots of growth, but also maybe tougher, more competitive markets.
Exactly. And this is where their strategy might face its next big test. They say they're focusing on improving volume through mass marketing, but specifically targeting profitable freight contracts.
So trying to grow volume, but keep the margins high.
That's the tightrope walk, isn't it? They just spent 18 months shedding low-margin volume to boost profitability to over 20%. Now they're pushing into new competitive territories. Will they need to price more aggressively to gain share there? How do you balance maintaining that hard-won high realization with the need for volume growth to actually penetrate these new markets?
Yeah, can you do both? Can you grab market share aggressively and keep that premium margin? That's going to be fascinating to watch.
It really is. It's the classic tension. Oh, and one final point. They do mention sustainability efforts, small steps for now maybe, but they have 77 EV trucks, 109 CNG vehicles, exploring solar panels, rainwater harvesting too. So looking at long-term resilience beyond just diesel.
Good to hear. Okay, so let's try and synthesize this for everyone listening. VRL Logistics in H1 FY26 basically showed us a masterclass in strategic repositioning. They deliberately moved less stuff, but used their strong, owned asset base and really tight cost controls like that direct fuel purchasing to charge significantly more for the stuff they did move.
Right. They proved you don't have to just chase volume in logistics. If your operations are efficient enough, you can focus on value, on higher margins. They went from volume pusher to value creator.
A really powerful shift.
Absolutely. We saw how well it worked in their established markets. But the provocative thought to leave you with is about the future. As they push into the north and northeast now, that fundamental choice comes back into play. Their recent success was built on that premium, selective, high-margin approach, getting that 20% EBITDA. But is a path to growth and dominance in new competitive regions still paved with that same high margin? Or will they need sheer scale, maybe sacrificing some margin, to win market share?
Price versus volume, the eternal logistics dilemma.
Exactly. That's the tension to keep an eye on as VRL moves into this next phase. Will they stick to the premium playbook or adapt for scale?